6 Financial Market Chapter 6.1 Introduction. In economics, a market refers to a mechanism comprising different systems, institutions, individuals, infrastructures, and rules that enables different parties to engage in exchange. Exchange can be in the form of barter where goods and services are offered for other goods and services. However, in most markets, goods and services are offered in exchange for money. Financial market is a market where financial assets are created and traded. It functions as a transmission mechanism between investors or lenders and the borrowers or users that facilitates transfer of funds. Creation of financial assets can be in forms such as the initial issue of shares and debentures by a firm. Assets traded in the financial market not only include financial instruments like equity shares, bonds, debenture, etc., but also commodities such as gold, gemstone, and other precious metals. 6.1.1 Functions of financial market 1. It facilitates interaction between buyers and sellers, thus enabling trade and resource mobilization. 2. Financial markets provide a mechanism for price discovery to determine the relative value of different items based upon prices at which individuals are willing to buy or sell those items. 3. As financial markets are regulated by regulatory authorities and governed by rules, they provide security and confidence while dealing in financial assets. 4. Financial markets enable firms to raise capital for building new facilities, replacing machineries, and expanding their business through issue of shares, bonds, and other types of financial instruments. Financial markets also give different types of investment opportunities to individuals. 5. Financial markets ensure liquidity by providing a mechanism for an investor to sell the financial asset. 6. It facilitates transactions and provides information at a low cost. Financial markets provide valuable information about securities being traded in the market. It helps to save time, effort, and money that both buyers and sellers of a financial asset would have to otherwise spend to try and find each other. 6.1.2 Types of financial market: money market and capital market. Financial markets in India have two segments, one catering to the requirements of short-term funds and the other to the requirements of long-term funds. The short-term financial market is known as the money market, while the long-term financial market is known as the capital market. The money market fulfills the requirements of funds for the period up to 364 days, while the capital market does the same for the period above 364 days. Money market, capital market. Deals in short-term financial transactions. Less than 1 year. Deals with medium and long-term financial transactions. It is the source of working capital finances for firms. Finances for expansion of business that promotes capital formation. Usually more liquid instruments as they are short-term. Less liquidity potential as they are long-term instruments. Examples: certificate of deposits, T-bills, commercial paper, trade bills, etc. Examples: shares, debentures, bonds, and government securities, etc. RBI is the regulator of money market in India. Capital market is regulated by the SEBI, RBI, and Ministry of Finance. Mainly banks are involved, along with a few NBFCs. All financial institutions. Both organized and unorganized sectors operate in the Indian money market. It is a thoroughly organized sector. Functional, institutional classification of financial markets, capital markets, long-term funds, the money market, notional. Call money market short. Term credit markets, money markets, organized, unorganized, bill market, bank loans, Hundis, stock market, government bonds, corporate bonds, equities, loan from banks and NBFIs, loans from moneylenders and others, loans from indigenous bankers, moneylenders and others, commercial bills, treasury bills. Figure 6.1. Classification of financial markets. 6.2. Money market in India. Money market is a market for short-term funds. It provides an avenue for equalizing the surplus funds of lenders and the requirements of borrowers for short periods, from overnight up to a year. The Indian money market consists of the Reserve Bank of India, commercial banks, cooperative banks, and other specialized financial institutions. It should be noted that the money market does not deal in cash or money as such, but simply provides a market for short-term credit instruments, such as bills of exchange, promissory notes, commercial paper, treasury bills, etc. These financial instruments are a close substitute for money. 6.2.1 Classifications of money market in India. Money market in India has two segments: unorganized money market and organized money market. Unorganized money market refers to short-term financial markets that are not regulated like organized money markets in India, but are recognized by the government. Unorganized money markets have been present in India since ancient times and even before the development of organized money market. The unorganized money market in India can be further divided into three categories: unregulated non-bank financial intermediaries, indigenous bankers, and moneylender. 1. Unregulated non-bank financial intermediaries include instruments like chit funds, nidhi companies, and loan companies. A chit fund, fraternity fund, refers to an agreement arrived at by a group of individuals to invest a certain amount through periodic installments over a specified period of time. The chit fund provides access to savings and borrowings for people with limited access to banking facilities. It is a popular savings institution in India and one of the main parts of the unorganized money market industry. Chit funds in India are managed, conducted, and regulated according to the Chit Funds Act of 1982. Since chit funds are under concurrent list, both union and states have the powers of regulations. Chit funds are the Indian versions of rotating savings and credit associations found across the globe. We can understand the functioning of a chit fund through an example. Consider a chit fund with 100 subscribers contributing 100 Indian rupees every month. The monthly pool is 10,000 Indian rupees, and this is auctioned out every month. The winning bid would be the highest discount, and this discount would be distributed among the subscribers. Let's say that the winning bid is 1,000 Indian rupees. The winning bidder would receive 9,000 rupees, 10,000 rupees, 1,000, while the rest of the subscribers would receive 10 Indian rupees each, i.e. 1,000/100. Winners cannot enter the auction again and will be liable for the monthly subscription as the process is repeated for the duration of the scheme. The company managing the chit fund, foreman, would retain a commission from the prize amount every month. B. Nidhi company is a company with the object of cultivating the habit of thrift and saving amongst its members. It receives deposits from and lends to its members only for their mutual benefit. It is a company registered under the Companies Act, 2013, and is regulated by the Ministry of Corporate Affairs. Nidhi company is a class of non-banking financial company, NBFC, and so RBI also has powers to issue directives related to their deposit acceptance activities. However, since these NIDIs deal with their shareholder members only, RBI has exempted them from the core provisions of the RBI Act and other directions applicable to NBFCs. Banks. 2. Indigenous bankers are individuals or private firms which receive deposits and give loans and thereby operate as. 3. Moneylenders are individuals or groups involved in giving small personal loans at a very high interest rate. Generally, they give loans from their own wealth. They constitute the most localized form of money market in India and operate in the most exploitative way. Organized money market refers to a diverse set of regulated short-term financial market, depending upon different categories of businesses and industrial firms. India has 8 different organized money market instruments. 1. Treasury bill market. 2. Cash management bill, CMB. 3. Call money market. 4. Certificate of Deposit 5. Trade Bill 6. Commercial Paper Market 7. Repurchase Agreement, Repo and Reverse Repo Market 8. Money Market Mutual Fund. 1. Treasury Bill. Treasury bills are short-term, up to 1 year, borrowing instruments of the Government of India that enable investors to park their short-term surplus funds while reducing their market risk. It is issued as a promissory note by the RBI on behalf of the government. The T-bills are issued at a price less than their face value, discounted, and redeemed at face value. The profit of holding is the discount which an investor gets. No interest is paid on these bonds. For example, an investor can buy a 100 Indian rupees, 91-day, T-bill for a discount of 10 Indian rupees, i.e., at 90 Indian rupees. At the end of 91 days, the investor will get the face value, i.e., 100 Indian rupees, and hence a profit of 10 Indian rupees. These bills are secured instruments as it has government backing and hence virtually zero risk weightage associated with them. There are 5 types of the T-bills: A. 14-day, intermediate T-bills; B. 14-day, auctionable T-bills; C. 91-day T-bills; D. 182-day T-bills; E. 364-day T-bills. Out of the above 5 variants of the T-bills, at present, only the 91-day T-bills, 182-day T-bills, and the 364-day T-bills are issued by the government. The other 2 variants were discontinued in 2001. The secondary market of T-bills is very active and they have a higher degree of tradability, and hence, it is a very liquid instrument. 2. Cash management bills. Cash management bills instruments issued by the government to meet its temporary cash flow mismatches. They are almost similar to T-bills, with the only difference being CBMs are issued for periods less than 90 days while T-bills are usually issued for more than 90 days. It was introduced by the Government of India in consultation with the RBI in 2010. 3. Call money market. Call money is the interbank funds market in India. It deals in lending and borrowing by banks among themselves. It deals in very short-term loans that are from 1 to 14 days. Interest charged on such loans is called the call money rate, which is determined by the market. Earlier, the operation was localized within an area. Later, RBI created a centralized system in Mumbai. MIBOR equals Mumbai interbank offered rate. It is the rate at which lending is offered by the bank that has excess money. MIBIT equals Mumbai interbank bid rate. It is the rate of interest that a bank would be willing to pay to secure a deposit from another bank in the Indian interbank market. 4. Certificate of Deposit. Certificates of deposit, CDs, air short-term instruments issued by commercial banks and financial institutions, FIs. This instrument is issued in lieu of the funds deposited at a bank for a specified time period. These are similar to savings banks accounts and are virtually risk-free. Hence, they are freely transferable from one party to another. Their maturity period is between 7 days to 1 year for commercial. For financial institutions, the maturity is not less than a year and not more than 3 years. The minimum value of issuance is 1 Indian rupee lakh, and for higher values, it should be in multiples of 1 Indian rupee lakh. 5. Trade bill. Trade bill is a short-term, negotiable money market instrument created from a genuine commercial transaction. If traders buy some goods on credit, sellers will get the payment after the end of the credit period. But if any seller needs the money immediately, the seller can draw a bill of exchange with the buyer. This bill of exchange/trade bill indicates the amount of money payable and the date on which payment is to be made. This trade bill can now be discounted, encashment of the bill, with the bank before its maturity. On the date of maturity, the bank can directly get the payment from the drawee, i.e., the buyer of goods. When trade bills are accepted by commercial banks, it is known as commercial bills. It is an important source of short-term funds for trade and industry. 6. Commercial papers. Commercial paper, CP, is a type of unsecured money market instrument issued in the form of a promissory note issued by a corporate house for raising short-term credit. The issuing corporate houses should be a listed company with a working capital of not less than 5 Indian rupees crore. Commercial paper can be issued for a minimum of 7 days and a maximum of up to 1 year. It is issued in denominations of 5 Indian rupees lakh or multiples thereof. For the better safety of investors, all participants require a credit rating from a credit rating agency. 7. Repo/reverse repo. Repo is a short-term money market instrument that enables banks and other financial institutions to borrow money from the RBI by selling government securities with a promise of repurchase at a predetermined rate and date. In reverse repo, banks and other financial institutions lend money to the RBI for short-term by buying government securities with a promise to sell back these securities at a predetermined rate and time. Repo and reverse repo rate are announced by the RBI, and they are monetary policy tools to control money supply. Reverse repo allows banks to earn some extra income on their otherwise idle cash, and repo enables banks to solve their short-term money requirements. 8. Money market mutual funds. Money market mutual funds are mutual funds that invest money of its shareholders in short-term, high-quality liquid instruments such as treasury bills, T-bills, repurchase agreements, repos, commercial papers, and certificates of deposits, etc. 6.3. Capital market. Capital market is a market dealing in long-term, minimum 365 days, financial instruments including bonds and equities/shares. Entities that invest in bonds become creditors, while entities that invest in shares/equity acquire proportionate market ownership. It is an organized market that brings together the parties who demand the funds, industry and business, and those who supply the funds, investors. It is a link between saving surplus sectors, like households, and saving deficit sectors, like industries. Capital market provides long-term investment, without which creation of productive assets is not possible. The capital market comprises the primary capital market and the secondary capital. 6.3.1. Primary capital market and secondary capital market. Primary market is a part of the capital market where the securities are created, while the secondary market is a part of the capital market where these securities are traded by investors. In simple terms, the first buying or selling of a financial instrument happens in the primary market, while the resale or subsequent selling and buying until maturity happens in the secondary market. The main difference between primary and secondary market lies in the fact that while the former deals with the securities that the issuer issues for the first time, the latter deals in the existing securities. Unlike primary market, which results in capital formation, the secondary market facilitates only liquidity and marketability of outstanding debt and equity instruments. 6.3.2. Primary market. The fundraising in the primary market can be classified as follows: public issues, right issues, private placements, and preferential issues. 1. Public issue is the mode of fundraising where private corporations offer their shares for the first time to the public in a new stock issuance. It is known as initial public offering, IPO. It allows a company to raise capital from public investors. Companies must meet requirements by stock exchanges and the SEBI to hold an IPO. 2. Right issues is also a popular mode of fundraising by private corporations where a company makes an offer to existing shareholders to buy additional shares in the company at a discounted price. Rights offer price within a prescribed period. Unlike IPO, a rights issue is not offered to the general public, but only to the existing shareholders in proportion of their existing holdings. The eligible shareholders can either subscribe to the rights issue partly or fully, or can let the offer lapse by not opting to exercise their rights to purchase the additional shares, or can transfer their rights entitlements to other persons. 3. Preferential issues is an issue of shares or convertible securities by listed or unlisted companies to a select group of investors. A person holding preferential shares has the right to be paid from company assets before common stockholders if the company goes into bankruptcy. They usually do not have voting rights and are rewarded only by dividends. 4. Private placement is a mode of raising funds by sale of securities to a relatively small number of select investors. Investors invited to participate in private placement programs include wealthy individual investors, banks and other financial institutions, mutual funds, insurance companies, and pension funds. 6.3.3. Secondary market. Bought. Type secondary market is that part of the capital market where previously issued financial instruments are sold, and it is a market for outstanding securities, i.e., securities already issued and purchased by investors. There are 3 of instruments in the secondary capital market. 1. Pure instruments. These include shares, bonds, and debentures. They do not share features of one another. 2. Hybrid instruments. They have a combination of features of pure instruments, for example, a combination of bond and equity. 3. Derivatives. These instruments have no value of their own, but derive their value from one or more underlying financial assets. Some examples of derivatives include futures and options. 6.4. Equity and shares. Stock shares are the smallest unit into which total share capital of a company is divided. Share capital is the part of the capital of a company that comes from the issue of shares. Entities that own the shares of a corporation are called its shareholders. May be understood as a collection of shares, although both stocks and shares are used interchangeably. Equity is a measure of ownership of an asset and represents the money value of the asset after all the debts attached with the asset have been paid off. Shares are easily tradable, but equity cannot be easily traded. For dilution of ownership, a portion of equity is first converted into shares, and then shares are traded. Let us understand this with an example. Mr. A has a company with total assets of 100 CR and liability of 20 CR. This means Mr. A has 100% equity of his company, and the value of total equity is 80 CR. Mr. A wants to expand his business, for which he needs 40 crores. For this, Mr. A has decided to issue 1 crore shares, each worth 40 Indian rupees, to raise 40 crores from the market. This implies that Mr. A will be left with 50% equity, representing 40 Indian rupees crores. Mr. B has bought 50 lakh shares that were issued by Mr. A by paying 20 crores. With this, Mr. B has acquired 50% of the issued shares that represent 25% equity in the business. Although it appears that Mr. A has lost money, equity held by Mr. A becomes more valuable as the company expands and its valuation increases. Shares are of 2 types, i.e., equity shares and preferential shares. Equity shares are also known as ordinary share. Through these shares, the company raises capital for its business. Ownership rights are given to the shareholder proportional to the amount of shareholding. Equity shareholders also have voting rights. Dividends to equity shareholders depend on the profit and company policy. They are a higher risk instrument since returns are directly linked to the company's profit and share price. Shareholders of preference shares are given preference over equity shareholders. They receive dividends first, i.e., before equity shareholders. When a company is liquidated, its assets are sold and shareholders are paid. In this case, also, preference shareholders are paid first. They have no voting rights in a company. However, they have ownership in the company, but they cannot be part of its management. Preference shares offer fixed dividends, so they are not traded in a stock market. Profits are not decided as per share price. The share price of a company can go up and down, but the return to preference shareholders is pre-decided and fixed. Hence, they are a lesser risk and fixed return type of instrument. 6.5. Bonds. Bond is a long-term debt instrument in which an investor, public, lends money to an entity, corporate, government. The entity borrows the funds for a defined period of time at a variable or fixed interest rate. A bond is less risky than a share as it is a fixed interest rate instrument. For example, if a company has issued bonds, then it is liable to pay back as per predetermined arrangement of interest, no matter the value of its share price. As less risk is associated with bonds, profits are also less as compared to shares. Bonds are used by companies, corporate bonds, municipalities, states, and sovereign governments to raise money to finance a variety of projects and activities. Government securities are also a type of bond. These are known as treasury bills when issued for a short period, less than 1 year, and are called bonds when issued for more than 1 year. These instruments. Loans also have a fixed rate of interest. In India, the central government issues both treasury bills and bonds or dated securities, while the state governments issue only bonds or dated securities, which are called the state development SDLs. G-SECs carry practically no risk of default and, hence, are called risk-free gilt-hedged instruments. Investors buy bonds at face value, the price of a bond, or a principal amount that is returned at the end of a fixed period. Borrowers give interest payments to bondholders at a fixed rate or at a variable rate. Bearer bond is a type of bond that is unregistered, i.e., it is not registered on any name, and whoever bears/holds the bond is accepted as its owner. Coupons of interest are linked with the security and not the registered owner. Bonds usually fall into 2 categories: secured and unsecured bonds. Secured bonds are backed by an underlying asset, and in case the company defaults, i.e., fails to repay the principal and interest at the end of maturity of a bond, then bondholders can stake a claim to the underlying assets. Unsecured bonds are not backed by any underlying asset, also known as debentures. Related terms. 1. Face value. It is the money value representing the worth of bond at maturity. 2. Coupon rate. It is the interest rate paid on a bond by the issuer. 3. Tenure. Time period after which a bond matures. 6.5.1. Bond yield. Bond yield is the rate of returns realized on a bond. Bond yield doesn't include the principal amount. The rate of return is not fixed. It changes with the price of the bond. Suppose a buyer buys a bond of 30 Indian rupees at 10% yearly rate of interest from the government. It means that the government will be liable to pay an interest of 3 Indian rupees yearly to the borrower. Bond yield, in this case, is 10%. Now, wants to sell the bond. The selling of bonds would take place in a secondary market that has many sellers and buyers of the bonds. When sellers are more in number, it means that bonds are in large supply. If there are many sellers of bonds in the secondary market as compared to the buyers here will be the king. Will have to sell his bond at a lower price than the price for which he purchased it, because there are other sellers who want to sell their bonds. Let us assume that I sells it at 20 Indian rupees to a buyer. We should remember that this buyer shall continue to get the interest of 3 Indian rupees as promised initially by the government, because interest is calculated on the face value of the bond, 30 Indian rupees in this case. This means that the buyer will get an interest of 3 Indian rupees on a bond worth 20 Indian rupees, while was getting the same interest on his investment of 30 Indian rupees. Here, the buyer will gain because he is getting an interest of 15%, as 3 Indian rupees is 15% of 20 Indian rupees, while it was 10% of 30 Indian rupees. In this case, the bond price went down from 30 Indian rupees to 20 Indian rupees, while bond yield increased from 10% to 15%. When bond yield increases, demand for bonds also increases.
So an
increased demand will propel the bond prices up, thereby leading to a reduction in bond yield, which will further lead to reduction in demand. The opposite happens when the sellers are less and buyers are more. Here, the bond prices rise and bond yield goes down. 6.5.2. Impact of a declining bond yield. Consider a scenario where the world is suffering from recession and the global economy is reeling under a low growth rate. In such circumstances, an investor would prefer to invest his money in a safe avenue which safeguards his investment rather than looking for high return investment options. So, the investor would invest in government securities. This would lead to an increased demand for GSEC in the market. When the demand for GSEC increases, its price goes up. Upward trend in bond prices leads to lower yield. So, a fall in bond yield, amongst many other things, can also indicate slowdown in the economy. A decline in yield can be good for the equity markets because money starts flowing out of debt investments into equity investments. As bond yields go down, the equity markets tend to perform better, and as bond yields go up, equity markets tend to falter. A declining bond yield also reduces risk of bankruptcy. When bond yields go up, it is a signal that corporations will have to pay a higher interest cost on debt. As debt servicing costs go higher, the risk of bankruptcy and default also increases. This typically makes mid-cap and highly leveraged companies vulnerable. 6.5.3. Major factors impacting bond yield. 1. Interest rate in an economy and bond prices have an inverse relationship. When interest rate falls, investors seek to invest in instruments that provide higher returns. Since bonds have fixed interest rate, fall of interest rate does not affect them. Hence, bonds become more attractive, their price increases and yield decreases. Opposite happens in case of an increase in interest rate. 2. If inflation is rising or is expected to rise, investors would want higher returns to beat inflation. This decreases the attractiveness of bonds as they offer relatively low fixed interest rates. Thus, demand for bonds decreases, causing yields to rise and bond prices to fall. Also, as inflation rises, central banks tend to raise interest rates to control inflation. Thus, as explained in the above point, bond prices would fall. 3. If the government wants to borrow more, then it will have to issue more bonds, leading to an excess of bonds in the bond market, which will decrease the bond prices and bond yield will go up. Zero coupon bonds. Zero coupon bonds are bonds that have no periodic interest payment, and they're sold at a huge discount to the face value. On maturity, the bondholder receives payment equivalent to the face value of the bond. 6.6. Debentures. Stock debenture is a financial instrument used by private companies to raise long-term capital via debt. Debentures are not backed by any specific security, i.e., they are unsecured. People generally buy debentures because of the reputation and trust in the debenture issuing company. Many investors prefer debentures since they offer higher rate of interest than bonds. The holders of debentures do not get shareholding. Convertible debentures can be converted into shares of equity after a specified period. 6.7. Derivatives. Derivative is a financial instrument which derives its value/price from the underlying assets. It is a contract between two parties, and this contract derives its value/price from an underlying asset. The most common types of derivatives are futures, options, forwards, and swaps.
price.
Future/future contract is a legally binding agreement to buy or sell a particular commodity asset or security on a future date at a predetermined generally. The underlying asset in futures are commodities like grains, oil, etc. Futures contracts are traded on exchange while forward contracts are traded directly between seller and buyer. Hence, forward is also called an over-the-counter (OTC) transaction. Future contracts cannot be customized as per the needs of the parties involved, while forwards can be customized. Options contract is a type of derivatives contract that gives the buyer/holder of the contract the right, but not the obligation, to buy or sell the underlying asset at a predetermined price within or at the end of a specified period. Options are also traded on the stock exchange. SEBI regulates the derivatives market in India. 6.8. Stock exchange. Stock exchange is an institution that provides a platform for buying and selling of existing securities. As a market, the stock exchange facilitates the exchange of a security, share, debentures, etc. It helps companies raise finance, provide liquidity and safety of investment to the investors, and enhance the credit worthiness of individual companies. There are two major stock exchanges in India: Bombay Stock Exchange (BSE) and National Stock Exchange (NSE). 6.8.1. Stock market index. The stock market index is a barometer/indicator of market behavior. Performance of companies listed on a stock exchange is measured via a stock market index. It indicates day-to-day fluctuations in stock prices. The function of a stock index is to provide investors with information regarding the average share price in the market. There are around 5,000 companies listed on BSE, while NSE has around 1,600. It's impossible to measure the performance of every company listed on an exchange. Hence, the concept of an index is employed wherein performance of select few top-performing companies is tracked. Index is based on market capitalization, MCAP, of only a few selected companies. Market capitalization is the aggregate valuation of the company based on its current share price and the total number of outstanding stocks. It is calculated by multiplying the current market price of the company's share with the total outstanding shares of the company. Example, if a company has issued 10 crore shares with a value of 10 rupees per share, then its market capitalization equals 100 crore. MCAP of a company equals share price x number of issued shares. Shares are traded in the secondary market, so share price fluctuates daily. If the value of shares of a company is increasing, then it means business is expanding and the company is witnessing growth. Therefore, an index reflects the performance of the underlying companies and of the overall economy. However, sometimes index can also be dictated by market sentiment. For example, people might start buying shares of a company based on some rumor or political event. This can lead to artificial increase in the share price of a company due to increased demand. Increased share price will reflect an increased MCAP, and an increased MCAP will result in a higher value of Sensex/Nifty. 6.8.2. Major indices in India. There are two major indices in India: BSE Sensex and NSE Nifty. The BSE Sensex, Sensitive Plus Index, was launched in 1986. It comprises 30 companies and its base year is 1978 to 79. The major criterion for selection in the Sensex is large market capitalization. The index constituents have been revised by the BSE 20 times between 1986 and 2009. The Reliance Industries Ltd. RAL has the highest weightage of 12.91% in index market capitalization. NSE began equity trading in November 1994, and its volume surpassed that of the BSE in a very short span of time. NSE Nifty Index comprises of 50 companies. Besides these two indices, the other popular indices are the A. Economic Times Ordinary Share Price Index, B. Financial Express Ordinary Price Index, C. The RBI Index of Security Prices. The other major indices are the OECI Index, the CMI, Center for Monitoring Indian Economy Index, the CRISIL CNX Indices, Midcap 200, PSE Index. IT Index and MNC Index, and the Business Line All India Index. There are also regional stock exchanges. Major regional stock exchanges such as Kolkata, Chennai, Delhi, and Ahmedabad have their own indices. 6.9. Few terms related to financial market. 6.9.1. Foreign institutional investors FIIs. India. FIIs are any institutional investors which invest in the assets belonging to a different country other than that where these organizations are based. The SEBI, Foreign Institutional Investors, Regulations, 1995. Define foreign institutional investor as an institution established or incorporated outside which proposes to make investment in India in securities. They are eligible to purchase shares and convertible debentures issued by Indian companies under the Portfolio Investment Scheme, PS. An FII has restrictions on instruments it can invest. Cannot invest securities in the company which primary and is engaged or secondary markets proposes to engage, including shares in the following bonds, debentures, activities, etc. Business of chit companies, fund, or unlisted, listed, or nitty company, or to be listed on a recognized stock exchange in India, agricultural or plantation companies, activities, or unlisted, listed, or to be listed on a recognized stock exchange in India, dated government real estate securities business, or derivatives traded construction on a recognized of farmhouses stock exchange excluding commercial paper units of schemes floated by domestic mutual funds, including Unit Trust of India, development of townships, construction of residential/commercial premises, roads or bridges, or security receipts, SRs, issued by ARCs registered with the Reserve Bank of India, trading in transferable development rights, TDRs. FIs are considered as both a trigger and a catalyst for market performance as they encourage investment from all classes of investors. That further leads to growth in financial market trends under a self-organized system. 6.9.2. Participatory notes, P notes. P notes are instruments that allow an overseas investor to invest in Indian stock markets without registering themselves with SEBI. These are overseas derivative instruments issued by SEBI, registered FII to foreign investors for trading in the Indian stock market. These derivative instruments derive value from underlying securities, such as equity and equity-linked instruments. These notes are generally issued by associates of India-based foreign brokerage houses. Morgan Stanley, Credit Lyonnais, Citigroup, and Goldman Sachs are the biggest issuers of participatory notes. 6.9.3. Angel investors. An angel investor is a wealthy individual who invests in a small startup company in exchange for ownership equity in the company. Generally, angel investors invest during the beginning phase of a startup. Investment is made on the potential of a startup idea, and they take only advisory role. Angel investors operate independently. 6.9.4. Venture capital fund. Venture capital fund is made up of investments from wealthy individuals or companies who give their money to a venture capital firm to manage their investment portfolios and to invest in high risk startups in exchange for equity. Generally, venture capital funds invest at a relatively later stage, when startup idea has been proven, and invest a larger amount when compared to an angel investor in exchange for larger equity. VC firms usually demand some level of operational control and gain power to influence major decisions of the company they have invested in. 6.9.5. Insider trading. Stock. When a key employee having access to strategic information about the company uses it for trading in the companies, it is called insider trading. It is highly discouraged by the Securities and Exchange Board of India as it goes against the principle of fair trading. Here, the other stockholders are at a great disadvantage due to lack of important insider non-public information. It should be noted that not every kind of insider trading is illegal. 6.9.6. Sweat equity. Share sweat equity refers to a non-monetary contribution of individuals or founders, in form of labor, time, etc., toward a business venture or other project. Sweat equity is rewarded through sweat equity that are issued by a company to its employees or directors at a discount. It's an investment device that companies use as an incentive to retain their best talent. Section 79A of the Companies Act lays down conditions for the issue of sweat equity shares. The sweat equity shares of a listed company should be issued in accordance with the regulations made by the Securities and Exchange Board of India, SEBI. In the case of unlisted companies, sweat equity shares cannot be issued before 1 year of commencement of operations. 6.9.7. Floating rate bonds. Floating rate bonds are bonds that have a variable rate of interest. The rate of interest of a floating rate bond is linked to a benchmark rate and is reset at a regular interval. It is different from regular bonds as regular bonds have fixed interest rates. It has been introduced to take care of the falling market or to provide a cushion in times of falling interest rates in the economy. In India, the State Bank of India, SBI, was the first to introduce bonds with floating rates for retail investors. 6.9.8. Masala bonds. IFC. Masala bonds are bonds issued in Indian currency outside India by Indian entities to raise funds from foreign investors. The name Masala was given by the International Finance Corporation to simulate the appeal of culture and cuisine of India on the international platform. The first Masala bond was issued in 2014 by IFC for the infrastructure project. Investors from outside of India who would like to invest in Indian assets can invest in Masala bonds. 6.9.9. Mutual funds. Mutual fund is a fund created by pooling in money from a large number of investors to invest in the share market, stocks, bonds, money market instruments, and other assets. It is managed by professionally qualified persons with experience in investing in different asset classes. Each mutual fund is run by a group of qualified people who form a company called an asset management company, AMC, and the operations of the AMC are under the guidance of another group of people called trustees. Generally, mutual funds provide higher return, but they are subject to market risks. June 9th, 10. Hedge fund. Hedge funds are also pooled funds that are used for investment in a diverse set of instruments such as buying and selling equities, initiating arbitrage and trading bonds, currencies, convertible securities, commodities, and derivative products. Hedge funds are professionally managed. Hedge funds are more risky instruments and provide a higher rate of return on investment compared with mutual funds. Features: mutual funds, hedge funds, investors, general public, only large corpus investors, risk management, low degree of risk management, high degree of risk management mentality. Investor mentality, buy and hold, trading mentality, opportunistic, sensitivity, low sensitivity to price entry and exit point, high sensitivity to price entry and exit point taxation. Tax saving options available, heavy taxation. June 9th, 11. Credit rating and credit rating agency, CRA. A credit rating is an opinion of a particular credit agency regarding the ability and willingness of an entity, government, business, or individual to fulfill its financial obligations in completeness and within the established due dates. It signifies the likelihood a debtor will default and is used by investors, intermediaries such as investment banks, issuers of debt, and businesses and corporations. Credit rating agency, CRA, evaluates the credit rating of a debtor by analyzing the qualitative and quantitative attributes of the entity in question. Presently, 3 prominent CRAs control 85% of the overall ratings market: Moody's Investor Services, Standard & Poor's, S&P, and Fitch Group. There are different types of credit ratings. Investment grade ratings mean the investment is considered solely, and speculative grade rating implies that investments are high risk. June 9th, 12. Social Stock Exchange, SSE. SSE is a new concept, first floated by Union Finance Minister in budget speech for FY 2019-20. It allows investors to buy shares in a social enterprise that has been vetted by an official exchange. Social enterprises are non-loss, non-dividend paying companies established to address social problems. The SE and NSE has got SEBI nod for SSE. Different examples of SSE: UK Social Stock Exchange, Canada Social Venture Connection, and Singapore Impact Investment Exchange. June 9th, 13. Sovereign Green Bonds, SGRB. SGRB, green bonds are fixed income financial instruments which are used to fund projects that have positive environmental or climate benefits. When these bonds carry guarantees related to the repayment of principal and payment of interest by the sovereign or the government, they are called June 9th, 14. Infrastructure Investment Trusts, INVITs. INVITs is a collective investment scheme like mutual funds, which enables direct investment of small amounts of money from individual/institutional investors in infrastructure to earn a small portion of the income as return. It is regulated by the SEBI, Infrastructure Investment Trusts, Regulations, 2014. These are like real estate investment trusts, REITs, i.e., the listed entities which own, operate, and manage buildings/properties for generating income. June 9th, 15. Impact investing. It is an investment strategy that aims to generate specific beneficial social or environmental effects in addition to financial gains. Under it, investors consider a company's commitment to corporate social responsibility or the duty to positively serve society. E.g., Educate Girls Development Impact Bond was launched as a proof of concept project in Rajasthan. It is the world's first development impact bond, DIB, for education. June 9th, 16. Front running. Front running is a market malpractice where a dealer, trader, or fund manager who is aware of large upcoming share purchase order buys the same share in advance in bulk. Such bulk orders drive up share price. It is illegal in India. June 9th, 17. Short selling. Short selling is one of many investment strategies in which an investor bets on a stock or assets in the expectation that its price will fall in the future. Here, the investor borrows, rather than purchasing, shares of stock/asset from a lender and sells them in the market. If the price falls, the investor can repurchase it at the lower price, return them to the original lender, and pocket the difference as profit. Stock loses value. Short seller sells 10 shares of ABC stock for $500. Short seller returns 10 shares of ABC stock and keeps $100. Short seller buys 10 shares of ABC stock for $400. Short seller borrows 10 shares of ABC stock. Figure 6.2. Short selling.